in today's episode, we are going to talk about the underpayment of estimated tax. All right. Now, I will give this disclaimer that in today's episode, this is specifically for my individual taxpayers and their 1040. Okay.
Welcome to the Tax Relief with Timalyn Bowens podcast. Are you behind on taxes? Is the IRS threatening you or your business? Are you overwhelmed and confused about how to resolve your tax issues? Let's join Timalyn as she explains your options and how she may be able to help. Timalyn Bowens is America's favorite EA.
Family, welcome to episode 83 of the Tax Relief with Timalyn Bowens podcast. I keep running into this very, very, very common misperception about taxes, when they're actually due, and certain penalties that can be incurred. So that's why in today's episode, we are going to talk about the underpayment of estimated tax. All right. Now, I will give this disclaimer that in today's episode, this is specifically for my individual taxpayers and their 1040. Okay. There is a penalty for underpayment of estimated tax for corporations, but it's slightly different. So, we're all filing tax returns here as individuals. Just keep in mind that if you have a corporation, the rules will be slightly different. Okay. Now, I often remind you all that I'm on a personal mission to fill the tax literacy gap one taxpayer at a time. And with that being said, even if you don't have tax problems, I'm here to help you avoid having tax problems, okay? So I want to go with the basics because that's usually where people get messed up. They listen to their cousin that's the barber or the landscaper that's had a business for all this time. And well, that's the way they always do it. And that's the way the IRS is going to get you because you're listening to people who aren't tax experts and don't actually understand the tax law. So, with that being said, getting to the basics, here in the United States, we have a pay-as-you-go tax system, as I often remind you. That is why, if you are a W-2 employee, your employer is going to withhold those taxes each pay period and pay them in for you on your behalf. If you receive Social Security or a pension annuity, they withhold taxes each payment as well, once a month, and then they send that in on your behalf. So as you receive income, you should also be withholding income to submit for your current tax liability. Now, if you are self-employed, or you have rental properties and investments, it's your responsibility to make sure those get paid throughout the year in the form of quarterly estimated tax payments. All right. Now, the way that's going to look is April 15th, you're going to make an estimated tax payment for the income that you earn January 1st through March 31st. June 15th is for the income that's earned April 1st to May 31st. Yes, that is a shorter period. Then we're going to have September 15th for the income that you earned June 1st through August 1st. All right. And then January 15th should be your last estimated quarterly payment for income earned January 1st through December 31st. Now, if you have a tax liability, if you have a tax liability where it looks like you're going to owe when you file versus getting a refund, that final payment is due by April 15th or whatever the tax deadline is for that year. If the 15th falls on a weekend, then it's going to be the next business day. If we are ever in a situation like we were during the pandemic and the deadline gets pushed out to May, June, July, then that's going to be when that tax payment is due as well. So, I bring all of that up because I have self-employed individuals that tell me, oh, I'm not going to worry about paying my taxes throughout the year. I just pay at the end of the year. So I pay it all in one lump sum because I'm not going to give the IRS more of my money to hold throughout the year when I could keep it and gain interest on it. Okay. Well, that's your prerogative, but the IRS has been very clear in how quarterly estimates should be made. So, with that, if your payments were not made within that schedule, you could face the underpayment penalty. Now, there are ways to avoid the penalty. All right. They will send you a notice if you owe the underpayment of estimated tax that lets you know how it was calculated. Most of the time, if you're working with a tax professional, they will estimate that for you and include it on the tax return. But the way that they calculate it is going to be based on the tax that's shown on the original return. Okay. So when you file your 1040, it will have a proposed tax that you owe. And then we're going to also see the amount of credits that you have, which would be the estimated tax payments, right? That are going to go towards that. We'll also see any tax withholding that will also go to reduce that as well. Okay. Now, the tax on the return is going to be whatever is remaining. Okay, that's what the penalty is going to be based on. So they're going to look at the amount of the underpayment. Then they're going to also look at the period when the underpayment was due and underpaid. All right. And this is the kicker. They're going to look at the quarterly interest rates for underpayments to then calculate your penalty. Because the IRS interest is based on the Fed, right? So you could potentially have four different interest rates throughout the year because it changes each quarter. We do have some years where it stays the same, but in addition to having that penalty, they're going to go back and also look at interest. Okay. So the date they begin to charge interest is going to vary depending on the type of penalty. If at all possible, I would recommend that you pay the penalty in full to make sure that it doesn't keep accruing interest. Now, there are certain ways to get the penalty removed or reduced, right? So, when calculating the underpayment penalty and to see if you qualify for the waiver, if you're working with a tax professional, they will do Form 2210, okay? And that's going to take into consideration a few things. We have scenarios where if you or your spouse, if you're filing jointly, have retired within the past 2 years, but you also have to be over the age of 62 and you had a reasonable cause to underpay. All right. Or if you or your spouse became disabled. Okay. Now, when preparing the form 2210, and Form 2210 is the underpayment of estimated tax by individuals, estates, and trusts. Okay. When filling that out, if you had most of your income tax withheld early in the year instead of spreading it equally through the year, you may be able to get the penalty reduced or removed as well. Because some people have seasonal businesses, or if you were somebody who maybe you received a lump sum payment, it may have been severance pay, it could have been Social Security that you got a lump sum of because they didn't give you your benefits yet. If we're able to show that you had that withholding in the beginning of the year when you received that lump sum, we could potentially get the penalty to be removed or reduced as well. Now, something else on the 2210 that we're going to want to show to help you, get that removed or avoided, we need to make sure that If you owe less than $1,000 altogether, then we can avoid the penalty. But the truth of the matter is, when we're looking at if you owe less than $1,000 or more, we're not looking at if the balance is, I'm sorry, $1,000 or less. We're not looking at the balance being 1,000 or less. We're looking at the actual tax liability before anything is applied being less than 1,000. Okay. But you can avoid the penalty if you paid at least 90% of the tax shown on the return for the taxable year. So, for example, let's say that you underpaid your taxes and your tax liability for the year is $10,000. If you paid in at least 90 or $9,000, which is 90%, before April 15th, so by January 15th, because remember that's the last date to make that quarterly estimated payment. If you paid in at least $9,000 by that date, we can avoid the underpayment penalty. Now, if we have a scenario where you paid at least 100% of the tax shown on the return for the prior year, then you could also potentially avoid the penalty. So in that scenario, if we're looking at if you paid 90% of the tax shown on the return or 100% of the tax shown on the return for the prior year, the IRS is looking at whichever amount is less. Okay. So let's say that your income went up instead of being, I don't know, let's say instead of being $50,000, it's now $75,000, right? If you didn't pay in 90% of what you would owe based on 75,000, but you paid in 100% of what the tax liability was last year when you owed the or when you made the 50,000, then you could still avoid the penalty because we had a change in income where it went up and you paid at least what you would have owed last year, then we can avoid the penalty. They'll give you some grace there for that adjustment of income, right? Now, there, of course, are always exceptions. If your AGI was $150,000, and that is for my single, that's for my head of household, my married filing jointly. Then we're going to substitute a few percentages. Okay. So with that being said, we are going to put in 110% instead of 100. Okay. So if same situation I used earlier, let's say you're a single individual, last year you made 50,000. Okay. This year you made 75,000. So we're erasing the example that I just gave. Yes, I know. Sorry for the confusion. Instead of 100% of the tax that you owed last year for the 50,000, it would need to be 110% of what you owed in the prior year. So 100% of what that was, then we're going to add 10%. Okay. Now, that amount goes to 75,000 if you're married filing separately. I'm sorry, 75,000. You all please charge my head, not my heart. I'm still recovering from tax season, right? But if your adjusted gross income is more than that $150,000, then that's when you would get to do the 100% instead of the 110. Okay. Now, because we want to avoid the penalty altogether and not owe anything to the IRS, I'm going to urge you to please update your Form W-4s if you're an employee. There's a series for how to do that on the YouTube channel. Make sure that you have your tax withholding correct. Also, if you retire this year or you're planning to retire this year, so you have a W-2 for part of the year and you're going to have a pension for part of the year, There are also videos for that. So make sure you have your withholding for the pension correct or annuity. Make sure it's correct for the job if you're yet working it and haven't retired yet. And then you're going to want to also take into consideration if you have dividend income, interest income, if you have rental income, you can withhold for those types of income using your W-4, or you can make estimated tax payments using Form 1040-ES. I don't have a current video for that, but if that's something you'd like to see on the YouTube channel, just let me know down in the comments of this video. Now, this podcast. There are special rules for farmers and fishermen because that is another type of seasonal business. So it may be a little more difficult to actually have paid in equally in 4 quarters just because, there are going to be fluctuations of income based on the season, based on the weather, different conditions like that. So for them, they do get a little more leniency, but because a lot of my listeners are not farmers or fishers, I'm not going to go into the details of that in this episode. If you guys would like a separate episode or article on that, let me know down in the comments. Okay. I know that there were a few times where I got my words tied up. I apologize. Like I said, I'm recovering still from tax season, but I've heard at least 3 times since April 15th that people were waiting to pay their taxes when they filed their tax return. And I had to be the bearer of bad news, even though they weren't my clients. Like, hey, when you do that, you do incur an additional penalty and you potentially are going to be paying a little more interest by holding on to your money. Is the interest that you're paying out worth the interest that you were earning by holding on to it? I doubt it. But my job here with this episode is to make you aware of the implications of not paying your estimated tax payments or having proper tax withholding. So that's why in today's episode, I wanted to cover the underpayment of estimated tax by individuals. Okay. Now, if you're drowning in tax debt, penalties in addition to this one, I want to invite you to book a call with me at www.bowenstaxsolutions.com because you may be a candidate to have penalty abatement where the IRS removes some of these penalties. If you've already paid them, they refund some of these penalties. And we all just need a little bit of relief nowadays, right? And I don't want the IRS to levy your account, garnish your wages, or anything like that, right? I want you to be in control of your cash flow. I want you to have the information to make the decisions that you need so that you don't end up drowning in IRS debt. And you don't have to fight the IRS alone. All right. So again, if that's you, you can book a call with me at www.bowenstaxsolutions.com. Now, I will tell you it will be a paid call because it will be customized to your specific situation. So keep that in mind when you go to the website. But even if it's not me, make sure that you go get the help that you need. I'd like to thank you for taking the time to listen today. I'd like to thank Jim Ray Consulting Services for helping me get this message out to you. I hope you found the information helpful. Did you know 1 in 50 people have a tax problem? Please share this episode with your friends and family because you never know who may need help. Again, thanks for listening. Hey, just as a reminder, this podcast is for informational and educational purposes only. It provides a framework and possible solutions for solving your tax problems, but it is not legally binding. Please consult your tax professional regarding your specific tax situation.